Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video. Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Guys, thanks so much for joining us. We need to move on now. We have a market master for the day, Mahesh Patil, who joins into our discussion. He's a co-chief investment officer at Aditya Birla Sun Life. Mahesh, hi, good morning.
Good morning.
You've been hearing our discussion on Axis Bank. You think for banks that have, a big cleanup going on and perhaps the profitability could improve going ahead, is this a good time for investors to be accumulating?
Yeah, I think a lot of the corporate banks, where we've seen huge amount of increase in stress assets. So while the overall stress asset pool is not really increasing, it's the accelerated provision and recognition because of the new RBI norm, which is taking an impact on the P&L. So I think you will see a faster cleanup happen in some of these banks. I mean, this quarter we have seen in one of the banks. I think it will happen in others also. And I think I mean, if the banks are undergoing transformational changes and really trying to grow, get a right balance between the corporate book and the retail book, I think if you take a 2-year view in some of these stocks and assuming some kind of a cyclical recovery in the economy, I think they could be good bets considering the fact that the valuation in some of these banks are relatively lower compared to the retail banks.
Okay, well, actually, in Axis, you must point out that it's an aggressive growth in deposits and in low-cost deposits. Low-cost deposits now form 54%. I don't know of any other bank, not even SBI. I think it's south of 50 for even the mighty SBI. So that's a fairly decent achievement that current and savings account are 54% of their total funds. And I think retail anyway is about 80% of their total liability franchise, their total deposits. So that would prepare them as and when growth comes with cheaper cash than others. And of course, now they've also got from Bain Capital adequate amount of capital to grow. So market perhaps taking cognizance of all that, and now at 515, that's where Axis is sitting. Mahesh, how do you feel about the markets itself? You get this regular bout of bad news in terms of some bond yield or crude higher, but market has climbed. So now does it look like 11,000 or the old highs are possible in 2018?
Yeah, I think, I mean, market is still in a bullish phase is what we believe, right? And while the macro picture has kind of deteriorated a bit, I mean, you've seen headwinds from the global front. US bond yields are crossed 3%. Domestically, we've seen some pressure on the rupee, oil prices going higher. So the macro tailwinds are something which are keeping the market in check at this point in time. But the micro story is looking better. So corporate, I mean, we discussed earlier also, the high frequency indicators, whether it is the auto numbers coming in, commercial vehicles, airline traffic, and some of these numbers are showing that there is a recovery happening in some of these sectors. And as a result of that, you should see good earnings growth coming in. I mean, we'll have to wait and see how this quarter goes through. But I think as we move forward, we are expecting a better earnings growth, and that should take the market higher. Now, it's debatable, when that will happen. But I think during the course of this year, barring some unforeseen circumstances and some amount of correction could happen, I think, because we will see some nervousness on the global front, and the markets could react to that. It could so happen that the rupee itself might break out from this current zone. But as earnings growth pan out, I think you should see the market scaling newer highs. Whether it'll reach the earlier peak this year, I don't know. But clearly, we are still in the bull phase, and what we have seen is just a minor consolidation.
Okay, by the way, 10,686 now on the Nifty. This is a breakout, and the bank
on the RIL stock.
1,000 on RIL. Bank Nifty is breaking out, and just keep an eye on DLF. That is now I think perhaps the most interesting stock, because if Lodha is filing for IPO, and from 2009 to now, when they had filed in 2009, DLF from that point till now, Lodha is actually doubling its valuation. Yeah. And if you see Lodha's enterprise value, that would be somewhere around 56,000 crores. DLF's debt has now gone down to 5,000 crores and plans to be debt free this year. DLF's enterprise value, you're looking at 45,000 crores. So there's a massive mismatch between DLF and Lodha. So I think for my reckoning, this could well be the stock to watch out for as the Lodha IPO picks up, and that stock, of course, right now making highs of the morning. Good morning to you, first of all, Mahesh.
Good morning.
We've seen a big move in the market over the last 3 or 4 months. I was tracking the Bank Nifty and the Nifty IT. It's around 22-23% outperformance for IT index. You reckon large part of that move is done, and can the banks take back the leadership, or is the leadership going to be with IT now?
Yes, so IT has been a surprise pack in the last 3 months, and steadily it has outperformed the market, considering the fact that it had underperformed in the previous year. And there's nothing dramatically which has happened in terms of the earnings outlook. We have not seen any big upgrade to earnings, but at the margin, I think the outlook on the IT sector has improved. The growth, for the IT companies would have been a tad high by around a couple of percentage points. And also, I think it's the broader, when there is a slight concern in the market, we see some of these sectors which are more defensive in nature, very steady earnings, good cash flows, tend to attract some amount of attention. And also the fact that, we have seen last year the rupee was fairly strong, and there is a view that rupee could see some depreciation. We have seen that year till date, rupee has been one of the worst performing currencies in the emerging markets. Yes. And also looking at the current account deficit, you could see further depreciation from here. So that could provide some upside to the IT stocks, which probably not factored into the earnings. And that's what has risen to the outperformance. But I think you'll see sector rotation happening, and we've seen that happen across. For the market to really gain leadership from here and gain higher, you'll have to see the other sectors start to participate, and banking would be one of the lead sectors really to lead that change.
Okay, in fact, you do have a lot of banks, HDFC, ICICI Bank, Kotak in your frontline equity fund. But the stock I want to talk to you about is Reliance Industries, because that also features as your top holding in the frontline equity fund. It's actually crossed the 1,000 rupee mark now. It comes out with earnings today. Not drilling down into specifics, but the petchem business, you think in general is on an uptrend?
So the petrochemical business, we have seen slightly better outlook over there. The prices and the margins have been good, but I think the refining space is where if you take a couple of years view, there are not new capacities which are coming up. And looking at where the oil prices are and the demand is, there is a possibility that the refining margins could really go higher. And because of various concerns in terms of alternate fuels, we're not seeing any big capacity coming up in the refining space. And that could be a surprise. On the refining margins, that's what a lot of the global guys are starting talking about. There could be some kind of a demand-supply mismatch coming up in the next couple of years. So I think that's a space, purely on refining margins, if you look at, I think there is a possibility of significant earnings upgrade to happen.
So what are you guys forecasting? Because refining margins in general have been around 11.4 or so.
So currently they are slightly weak. There's a seasonal weakness which is there, which is fine. But I think going forward, as we come out of this, there is, again, it might not happen in the next 3 to 6 months, but clearly over a 1 or 2 year time frame, I think you will see much hardening in refining margins. Okay, so even the oil marketing companies, would you like? Yeah, so oil marketing companies are, currently they are at very attractive valuations. And I think there the pain point has been in terms of the marketing margins. I think refining margins would, again, they will also benefit because of stronger refining margins. But the marketing margins is where some kind of uncertainty has come in as oil prices have gone up. Whether the government has the will to really allow these companies to make up and to sustain those margins is something which will be tested in this kind of environment. But I think our view is that the government has made it very clear that they will allow these companies to make reasonable margins, and they have shown intention to also cut the excise duty if the oil prices go up. So I think they could be still good contra bets at this point in time, because the valuations are extremely cheap over there. But because there are elections, large elections coming around the corner, I think there will be some apprehensions. I think as you pass those hurdles, and if they continue to maintain their margins, I think you will see a slow re-rating happening in this oil marketing companies.